there's nobody here yet. When you start talking, make sure you're looking at the camera up here. Hi, everybody. We're just hitting 11 o'clock, so we're going to give everybody about a minute here to log in, and then we will get going. So as the screen says, welcome. Okay, we are hitting the top of the hour, so we're going to get going here. Welcome, everybody. Welcome. Thank you for joining us for our fourth quarter webinar. As you can see, we have a special guest, Will Schroeder, here with us today. So you all know him from Will's Weekly and all the meetings that we have together here in the office. So we are going to be discussing market dynamics, the economy, telling a few stories about what's going on out there. Just we like to at least once a quarter update everybody on what we're thinking and hearing, and we spend a lot of time with this information every day. So for us, it's second nature, but for all of you, it might be, not something that you spend a lot of time on. So we want to make it easy and digestible and just give you some updates as to what we've seen as we're heading into year end. We expected a lot of volatility at the end of this year because of the election, and we just haven't seen that yet. So we'll comment on that, but as well as what's going on in the world of interest rates and the markets as a whole and the economy as a whole as well. So, all right. Got a slideshow here, so we're going to go ahead and kick that off. Bear with me 1 second. And Will and I will be tucked here in the right-hand corner, as you can see. So, all right. So the market update is what we're going to be talking about. Here's our disclosures. So important. Make sure you read those. It's interesting to me because as we were entering into the beginning of 2023 last year, we felt, and we're reading everywhere, that a recession was imminent, that the economy was due for a harsh slowdown, and that we were going to see everything pull back pretty dramatically last year. It was, everybody can remember, that did not happen. It's interesting this year, I still see the same headlines. I still see new major flashes of recession signal. A lot of stocks are being purchased like Coca-Cola because people are expecting a recession. Interestingly enough, that's not what we've seen at all. The economy has done well, the markets have done well, and we've begun to see continued growth in the markets as a whole. So it's an interesting dynamic, but there's so much negativity out there, and we see that in definitely the financial press, but I think the election pressure is making it even worse. Here you can see then what's going on with the economy as it continues to go straight right. I've put a couple highlights in here. It's circled areas where we had like the COVID recession and the pullback in 08 and 09. But generally speaking, up and to the right is what's been going on with the economy. We're seeing it continue to grow. You can see on the right-hand side of this chart components of GDP. The big blue box is consumption. That's money that we all spend. That's what keeps the economy growing over time. The consumer, because there's been so much money available to them, continues to spend and grow. As we move into the holiday season, we'll hear a lot about this. Are consumers still spending? Are they nervous? In general, we've seen this trend continue to only go up and to the right. And even with some of these pullbacks along the way, the trend is very solid and very much heading in that positive direction. And so now what you're hearing a lot about is a few things. One, the stock market's at a high. Should I sell? The second is there's a lot of federal debt. Is that going to be a problem, or is that a problem? This chart demonstrates where all the money goes. And if you look on the left-hand side under the 2024 federal budget, Medicare, Social Security, and defense are the big parts of where our GDP, the money that we're bringing in taxes and the growth overall in the economy, is being spent. And so that is a huge chunk of the economy, well over 60%. So when you hear a lot of partisan bickering about the budget and spending less money, it's the top areas, the ones that are disposable and non-discretionary, because no politicians want to touch Medicare or Social Security or propose any changes to those. So for those of you that are on our email list, you've been seeing some of my comments lately about Social Security and the solvency of that program. But you can see when they're planning our budget and talking about our federal finances, these are huge parts of it and areas that are going to have to be addressed. So as we look into the future and we look into where we're going to have to make changes in the American economy, this is it. And we're seeing on the right-hand side of that, the red bars are if the Tax Cut and Jobs Act gets extended. That is all going to come up into Congress next year. So we'll have a new president at that time, and we will have a big congressional battle over how this is going to work. Are those tax cuts going to expire? All of that kind of stuff. So it'll be interesting to see how that plays out. And at some point, this is going to have to be addressed. You're going to hear me say a lot more about this as we move into the future, but we are going to have to see our federal finances get addressed because we can't continue to spend at deficit balances and make that work over time. All right, so Will, we've seen a lot of our clients, their children get involved in, I want to buy a house, but rates are too high. I'm really concerned about, am I getting a good deal on houses right now? What are you kind of seeing overall in the housing market?
Yeah, I think this is a big topic of discussion, especially for my age group, but everyone else as well. Where interest rates have been over the last year or two, they've been escalated, bringing mortgages to around, people are getting mortgages for 7, 8, 9%. We've seen that come down a little bit. As of today, the 30-year mortgage rate's sitting right around 6.5%, and we see that trend continue. We don't think it's going to go down to zero, or when people have 2 or 3% mortgages. We don't see that in the near term, maybe somewhere around 5, 4, 5, and staying in that range for the time being. But if you look at the chart in the top left, you can see that housing affordability has come down significantly, and we are starting to see a slight uptick. If you look at the very far right of that chart, you can see it start to tick back up. So we'll see where that trend takes us. But our consensus is that things are starting to moderate. They might not be great yet, but they are beginning to moderate. And you can see that in the chart in the bottom left. That's just tracking the mortgage rate. You can see that's starting to dip down as well.
Yeah, I feel like in the housing there's just been a freeze because you've got people that are at low rate mortgages that aren't going anywhere because they've got such a low rate mortgage on their house. There are those that have their house paid off, so they don't want to go and sell it while they can get a good price for their house today. They have to pay a lot to get a new one. And then there's that third bucket, which is folks like you and your demographic, Will, we want to buy a house, but our rate's going to get better. Should we wait to buy? Our pricing going to come down? And so the whole thing's beginning to thaw, I think, is what we're seeing, is that you're seeing more houses for sale. You've seen rates come down a little bit. People that have been waiting are getting anxious. I still see a lot of building throughout the Des Moines and central Iowa area, and I'm suspecting people see that around their neighborhoods as well. So people are buying lower or building lower price homes and buying those so they can still have the joy of a new house at hopefully a 6 to 7% rate versus 8 or 9, and get a chance to build some equity in there. So this will be an interesting thing to watch.
And one last thing, with that first rate cut that happened, there was a huge surge in mortgage refinances. And I would expect to continue to see that as if rates continue to come down, people with those 8, 9% mortgages refinancing for a lower rate.
Good point. All right, let's talk about the stock market. So another good year. The chart that I've got here demonstrates the different parts of the market. The pink one at the top remains the Magnificent Seven. These stocks continue to outperform. I've been talking about it for 2 years, just the craziness with how much it's gone up. You can see in July when there was a correction how severe the drop was in that area of the market, but now it's returned right back up and is up 41%. So when I talk about the Magnificent Seven, it is NVIDIA, Apple, Microsoft, Google, Meta, these names that you're all are familiar. They're all part of our household. And 20 years ago, they weren't. Maybe Apple a little bit, but so many of these companies have resurged and continued to grow, and they do it on the backs of the expectations around artificial intelligence. What that's going to mean, it really is taking shape to become the internet boom of the 2000s. I recently returned from a conference with Sanctuary, and Marianne Bartels, our chief investment officer, talked about this extensively, that tech is a leader. It's going to remain a leader. We have very much a chance to see the markets go parabolic in this area, just like it did in the 2000s. But we can also remember then what happened on the backside of that was there was a severe downturn because companies weren't earning any money. It's different this time. And I say that sparingly because usually it never turns out to be different. But these companies are actually making money, and their prospects for growth continue to remain very, very strong. And so when we look at the valuations of these for now, they're earning their higher valuations and their higher multiples, but they have to continue to perform. And there are any myriad of things that could derail those plans. And so while we are interested in this part of the market, we want to participate where we can. We also want to be smart and prudent to say this is a high flyer and you're paying a high price for these type of stocks. And so when there is a correction, you would expect those prices to come back in line. But it also presents opportunities. So if you look at the middle bars and somewhere between the 15 and the 20%, a lot of the parts of the market are still performing very, very well. And these companies are also earning good amounts of money. So there's nothing to say that other parts of the market can't keep doing well, while we could see other parts of the top part of the market moderate a little bit. This just demonstrates that the valuations in these big seven are now over 35% of the weighting, and it's in the top 500 stocks. So the top right-hand side of this chart says 35.8%. So that is the weight, how much market capitalization or girth these have in the market right now. So when we see the markets move dramatically, it's usually being driven by one or all of these top seven names, where again, the underlying names could still do very well, and their valuations I've highlighted here are at 15 times earnings versus the top 10, which are over 20 times earnings. So that, in our mind, presents a bit of an opportunity. People are always worried to invest at all-time highs. Whenever you see markets hit new levels, for one, it's in your face on the news all day long. Hey, market hit a new high. Boy, then the next thing they say is a recession is coming. So remember, the media is there to get clicks. They are there to get attention and eyeballs. So when you hear it's at an all-time high, that does not mean you need to get out. It can very much continue to go on from here. And this shows that over a 5-year period, the average cumulative S&P total returns after an all-time high, we're still up over 80%. We want to participate in this market. We want to be invested and stick to our plans and our goals during this period of time. All right, so the Fed started lowering interest rates. Well, they went down 50 basis points. We thought that was pretty dramatic. Everybody was expecting a little bit lower of a rate cut. What usually happens after these type of cycles start?
Well, you can see these two charts are just demonstrating market returns after the first cut. That's what that dashed line is there. And you can see besides 01 and 07, they've been positive. That doesn't mean, like, historically, past performance doesn't guarantee future results. But,
oh, well said. I love it. Hedging.
the trend here is generally positive after a first rate cut. And so that's what we would expect to happen with this year's market as well.
Yeah, it's really interesting to me, this 10-year chart on the right, where every time we've started a rate cutting cycle over 10 years, prices have been up. So if you're a long-term investor, which all of our folks are, depending on what bucket of money we're working on, you can see that it behooves you to stay involved, even though there might be bumps along the way. So interesting. All right, so the sectors were something that we always look at, because there's always the expectation that a certain sector is going to do well in a given environment. And I find that nothing becomes more contrarian or against what the market is saying than sector performance. And so it's also interesting to see it under different presidential terms, because people that you would expect would have done well in the energy sector, for instance, don't. It usually is the opposite. And so this year, utilities, year to date, has been our best performer. And all we have to do is look around what's going on in your cities and where you live to see that utilities, electricity, infrastructure, building, all of that is going on everywhere. If you drive down the road here to the Des Moines airport, there are, I think, 7 cranes I counted coming in this morning. And I'm not talking about the birds. I'm talking about the big machinery putting in a huge project, hundreds of millions of dollars into a new airport. That is going on everywhere. We've traveled this year to Nashville, to other different parts of the country, and growth is going on everywhere, and it's the infrastructure, the roads and the bridges. Utilities have been our top performer, even more so than information technology and communication services, which are the Mag 7. So when everybody says it's got to be the banks, it's got to be energy, when we have a new president, this is what's going to happen in sectors, I'd encourage you to do the opposite if you're feeling aggressive, if you're feeling ornery. Go, if you think energy is going to do horribly under a Harris administration, buy it. If you think tech's going to do horribly under a Trump administration, buy it and see what happens, because over time, these contrarian trends start to play out. So while we feel very bullish on technology and the things that are going on there, these lower parts of the market like healthcare and real estate have been very depressed and could very well begin to reemerge under a new administration and a new economic cycle. All right, we talked a lot about stocks. We want to shift to bonds a little bit. So when the Fed's lowering rates, Will, what is that? What happens to the parts of the market? What part of the rate curve are they impacting?
So when the lower rates are impacting the short end of the curve, so the shorter term maturities. So right now we're kind of it's called an inverted yield curve. I'm going to try and demonstrate this on camera. You can't really see me, but it's opposite of what it normally is. And so by lowering short-term rates, they're trying to bring the curve back to some sort of normal curve where you can get better rates on the longer term maturities.
Right. Yeah. So every time we've had an inverted yield curve with high short-term rates and low long-term rates, we've had a recession. And so this has been inverted for a while, and it's actually beginning to normalize because the Fed's bringing down those rates, right? And then, so what we're beginning to think is that maybe this is going to tilt back up. And a lot of times when that happens, there's a recession. So people will find an excuse for a recession wherever they can. But we think bonds present an interesting opportunity because rates could be stable here for a while, but we don't feel that inflation is actually out of what I'll call the danger zone. So Will's shown you this chart a lot in your reviews as far as how inflation early on was big on energy and now it's more on shelter. But we both, when we talk about this and we hear from Marianne and JP Morgan and other folks that we use as a resource, that inflation is very malleable, and it would be very easy for it to spark back up if there's a lot of government spending, or there's these tariff issues and some import-export imbalances. Housing could get askew. There's a number of things that could put inflation back up. And so while we're seeing the Fed lower rates because they want to keep inflation down, they could screw this up where they lower rates and then all of a sudden we have inflation again, and they'll have to come back in and raise rates. And you can bet politically the Fed will be thrown under the bus if that happens. And Chairman Powell and all of his cohorts will be thrown, like I said, under the bus, and changes will be expected to be made at the Federal Reserve. Well, the Federal Reserve has an independent mandate to keep inflation down and keep unemployment down. And that's their only job. It's not to be political, but unfortunately that's where we're at in the current environment. So we personally as advisors would hate to see the government intervening in how the Fed behaves. They're supposed to be an independent area, kind of like the Congressional Budget Office. Unfortunately, politics has filtered into everything. So our outlook on inflation is to stabilize, and that there is a threat in the next couple of years where we could see it spike again. All right, so when we talk about artificial intelligence, we talk about infrastructure, we talk about utilities, all of that. A lot of it bears down on things like electricity and overall energy policy. So what are we seeing here on this chart, Will?
This is just showing you the electricity demand. I like the chart in the top right from these data centers. All these companies that are diving into the AI space, they're putting data centers everywhere across the country, and they need so much power to run. So a new conversation that's come up is AI sustainable because of its energy demand through these data centers? And so people are starting to look to other areas besides electricity, and the big one is nuclear. Is that going to work? We don't know, but it's something to keep your eye on. We'll keep our eye on it, and it could present some opportunities like in the utility space and the infrastructure space, like Matt mentioned earlier.
Yeah, so interesting times. We're seeing, the big concern about the election just hasn't panned out. Now we have it coming up, 15, 20 days, something like that. Will and I are both going to be excited for when we can watch the local news and not be inundated with Lanam Bakam and Zach Nunn, who's on our billboard outside here, and all the local races. Of course, the presidential morass is out there waiting for us too. it'll be interesting to see. We sure hope that it's a peaceful election, that it does get resolved quickly. And the best outlook for the markets, frankly, is gridlock. If we have a split in the branches and not a lot is able to get passed through, the markets tend to like that because companies can then make plans for how they want to spend their money, where they want to invest. We think the infrastructure, and we got this opinion in conjunction with Richard Bernstein, who we follow closely, is probably one of the biggest opportunities in the investment markets in the next decade. So we'll be finding themes to implement that in all of our client portfolios as we move forward here. The important thing that we want to say is let's see this through year end. Let's be smart about how we're handling taxes, capital gains. Let's expect that the Tax and Cuts and Jobs Act is going to change, and we need to plan accordingly for that, whether it be our tax brackets or our estate plans. And all of this going into, are your goals the same? And if so, then we need to stay the course and stay invested and well balanced. And as we move through what could be a volatile period, be ready for what may come next, be in front of these opportunities as we see them, and make sure that we're staying in touch and understanding what's going on in everybody's lives. So any closing thoughts on the markets, Will?
They just continue to rip on, and like that chart you showed earlier with all those new time highs, they continue to beat those. So don't be scared and think that tomorrow the market is going to go down. It could, it might not, we don't know. So yeah, like you said, stay the course, stay invested.
We're going to save this recording for Will for when we actually have a really, really bad market, so he can, because he has not experienced that yet in his youthful life. I've been through many with all of you, and we're ready for those for when they come. And Will be too. He won't know what's going on. He'll probably be running up and down the hall, and I'll have to calm him down. But if that's the case, so be it. We'll be ready for that. So thank you all for being part of this. We hope it's been helpful. Your feedback, of course, is always welcome. I'm going to check the chat, see if there's any questions in here before we head off. I'm not seeing any. So again, thank you all for attending, and we look forward to seeing everybody here in the fourth quarter, getting ready for the holidays and eventually 2025. Thanks.
Thanks, everyone.